Hey everyone, going on now with our next market, and we're looking at fixed income and bonds. So there's another fairly big topic here, listing the major types of issuers of debt securities. Who are the people that issue these types of things? The basic terms, what do they all mean, and how do we work out their prices? State the ways which prices are expressed. Explain the relationship between price and yield. And the inverse relationship there. Define a yield curve, we'll look at those as well. And then describe the importance of US government debt in pricing other debts as well. And then the securities yield or credit spread as well. So going in, obviously when governments need to raise money, they do that by going to the money market and selling bonds into the market. So it's really just debt, but it's guaranteed by the government as well. So they're either funding budget shortfalls or seeking investors, to make up that shortfall. The two main vehicles the government will often use is the money market, where it obtains funds for up to 1 year, and they're called bills. Now again, this wasn't in the text this year, but I still think you could get asked questions on this. So I want to just sort of touch on that. So short term, up to a year, is bills. Anything longer is called bonds. Now that is really US centric. I haven't heard of bills in other countries, but if you do get a question on that, remember bills are anything up to 1 year. The bond market, where it can borrow for up to 30 years, and then notes and bonds. Notes and bonds are pretty much the same. One of the differences with bills is that a bill has a face value. So let's say the face value was $1,000. Well, when the government sells it, it sells it at discount. So instead of $1,000, it may be $950. And so there'd be a 5% yield on that bill, but the government's getting the money now and they'll pay you $1,000 later. There's no interest, there's no other payments that are going on. Basically, it's the face value that you are getting back from that. Every other bond works as we talk about in this session, as the chapter talks about. Again, I mention that because I just want you to be aware in case some rogue questions come your way. Both are sold through auctions. Bills and bonds are typically sold through auctions. So essentially, the way it works is the government goes to auction. The people who are buying at the auction are the big banks. And they're almost compelled, actually they are, they're compelled to be there by the government. Whether they want to buy or not, they have to buy. So they buy all of this debt from the government and then go to the secondary markets, where other investors then buy and sell those bonds and bills as well. And the government can compel the largest banks to participate in the auctions. Sounds nasty. So what are bonds? A bond is between a borrower and a lender. It's also called fixed income because when you buy a bond, there is an agreed payment schedule of interest that you're going to get for that duration. And at the end of that duration, the government or the company, whoever issued the bond, is going to pay you back. The reason why we have this inverse relationship, we have an inverse relationship between bonds and yields, and that's simply because the bond price is dependent on the yield. Now the yield is, for this price, for if I spend $1,000 on a bond, what interest rate am I getting back? When I count all of my payments back, what is my yield for owning that bond? Now, if the price of bonds goes down, well, obviously my yield is going to be higher, so yields go up. If the price of bonds go up, well, then my yield, my return is low because it's fixed income. That yield, that return is not going to change. So as the prices of bonds, 30-year bonds move up and down, well, you can see the yield changes in an inverse way. Also called fixed income because typical bonds pay a fixed payment over its life. There are some inflation adjusted tips and things like that. The text doesn't talk about those anymore, so you should be right. The borrower, companies or governments, so they're the two types of issuers of bonds, companies and governments. They turn to public markets to raise funds. The most important thing to know is that yields and bonds prices move inversely to each other. So why buy bonds? Mainly for the interest payments. So when you're talking about a diversified portfolio, you may have some stocks for dividends and income, but also for capital growth reasons as well. But to balance that out, there is some fixed income that you want to have, which just constantly provides a fixed dollar amount every month. You know, if you've got a lot of money to invest, well then a big portion of fixed income is a great way to do it. It's government guaranteed, so long as you think the US government isn't going to go broke. And you are going to get a fixed income coming from those bonds. There's a possibility of capital gains if interest rates drop. So obviously the price of the bond. So if interest rates drop, the general, and you've locked in a 30-year bond at a high rate, well, that bond becomes worth quite a bit. And there is a capital gain component to that because it's paying a much higher premium than what a 30-year bond would today. Investors know in advance when they get paid, how much they get paid, when they redeem their investment. And so that's why a lot of people like to have a balanced portfolio of that. Bonds have a higher place in the liquidation order. They're pretty much first after government taxes. In a portfolio, bonds help to smooth out the returns of more uncertain assets. Even when we have dividends and income from holding shares, some years the company may not be able to pay dividends. And so again, that's why bonds continue to provide income at all times. So the bond issuers, as we said, two groups who issue bonds are governments and corporations. At the government level, we obviously have the national, the federal government, or sovereign government, sometimes they're called in different countries. State and regional can issue bonds. And then mainly in the US, we have local municipalities as well. Bit of a tongue twister. So we have those as well who can issue bonds. And so, you know, often here in Charlotte, where we're based at the moment, in North Carolina, we often hear that the city is issuing bonds to do new schools and things like that. And so they're putting bonds out, investors are buying them, and that's the way that they're funding their expansion. National bonds are backed by the full faith, credit, and taxing power of the government, of the US federal government. Cities and states even can go bankrupt. Countries don't go bankrupt that often. It can happen, and it has happened in the past, but it doesn't happen that often, especially the big first world countries. Definitely in 2008, there was a real concern that there was going to be a number of countries that would go bankrupt. So there definitely is that chance. The fact is, if there was zero risk at all, well, there would be zero return. So to get a return, we have to have risk. And so there is a risk of that, but it's one of the safest. And, you know, we do call the 10-year bonds the risk-free rate. It's often used for that. But I think that's a little bit of a misnomer because there is an element of risk, even though it's extremely small. States and local municipalities, they don't have that same government guarantee. You know, they can go broke, and that happens a lot more often. So you would expect a higher yield on those because there's a higher risk associated with them. So typically a bond represents $1,000 units of currency, you know, but we have had bonds before. You can see here it's a $100,000 bond. So there are different face values, but when we talk about bond prices, typically it's $1,000 units. So bond issuers. So we have independent countries, so sovereign, federal, national, state government, you know, state, provincial, local are the names that are commonly used. State only, municipal and tax exempt is often what's talked about here at a state level, but that's US only. Corporations, high grade, investment grade, junk, and high yield, which is a nice way of saying really, really bad. You know, your risk of going broke is extremely high. So you don't want a portfolio just made up of high yield. You would have a balanced portfolio again. Some common names here, United States, we have treasury bonds, notes, bills, Germany, Bunds, Blobs, Scholz, Oats, BTFs and BTANs in France. The Gilts is United Kingdom. The JBGs are in Japan. You'll often hear them talked about, especially with fixed income traders and analysis, etc. But again, I think this is just something handy to know. Make sure you know it. So if you see those names, bond issuers, I think, these sorts of names, I think you do really need to know. This side, not so sure, but if you can remember it, great. Just stick it on the wall again and just read it every day between now and the exam. So the bond components, what's a bond made up of? So there's obviously the principal, that's the face value. So when we look at this one back here, well, the face value is the 100,000. It's what you paid. Well, not necessarily what you paid, because you may have paid at premium, but it's what you are going to get paid back when that bond matures or expires. So that's the amount that's going to be returned. The maturity, the date at which the principal is returned to the investor. So if it's a 30-year bond, well, that maturity date is going to be in 30 years' time. Although it can be less, because that bond may have been written 5 years ago and you're buying it off someone else. And so in 25 years, it'll be maturing. The coupon, the periodic interest payment that is made. So it's typically 6 monthly. It can be different time frames. They are, different, but the payments that are made are called the coupon. And when you talk about it as a percentage, it's the coupon rate. Yield is the coupon divided by the price paid. So again, this is the yield of, if I buy this bond, even though I'm buying it above or below its par value or something like that, what is the yield that I'm going to get from that? So the first person who buys when the prices are low and then gets a capital gain and sells it, well, the yields between those two buyers are going to be very different because it's depending on how much they paid for how much they're going to get back through it. Par value, the nominal or face value of the bond in percent. So a bond trading at 105 would cost $1,050. That's 105% of the face value. So that's the par value of that. The duration, the time it takes to recoup the original investment. So depending on what a bond pays. So if I bought let's just say, fanciful numbers here, but let's just say I bought a 30-year bond and it was paying a 10% interest. Well, obviously after about 7 years or something like that, I would actually recoup my initial investment. So my duration would be 7 years, even though the bond was a 30-year bond. So that's that. All right, so bonds and value. Quoted price is a percentage of face value. Typically, when we look at prices on quote feeds and things like that, we're looking at that. So if the face value is 1,000 and the quote's 100, then the price is 1,000 because it's 100% of the face value. So here we've got 102% of the face value, which means the market price is 1,020. Similarly, we have 97% of the face value, so it's 907. We call that a discount to par, or a premium to par. And then obviously this one here at 100% is par. So when a bond price is greater than 100, the yield is lower than the coupon rate. Yields are nominal returns. They do not factor in inflation. So of course, it's not inflation adjusted. Although there are some variation, as I said, tips are one where they are inflation adjusted as well. If inflation exceeds yields, then real returns can be negative as well. All right, so yield to maturity includes all income. So this is basically the full yield. This is everything that you're going to make by owning that bond. So all income, capital gain, the return of the principal when the bond matures. Now it's hard to forecast the capital gain that you may get. So, it's often this is a retrospective calculation rather than a forecast or anything like that. Although there's guesses that are being made. Rating is a quality metric to let the investors know about the issuer. So we've got AAA, AAA plus, quadruple A, down to Bs and down to junk as well. So every bond is rated. And the reason why that's so important is that, when it's AAA, well, then you think, okay, I'm not going to get that much of a premium over, let's say, US government 10-year bonds. But if it was down at junk bond level, well, then you want to be getting a massive premium because you're taking on that risk. So again, that's why these ratings are important. It's really a way of these credit agencies looking and saying, what is the risk that the issuer, the corporate, the government is likely to default? And there's all these metrics. If let's say it's government, the economy's strong, the population's well employed, there's lots of contribution to the tax base, well, then the risk of that's pretty small. So we don't worry about that too much. But if it's a company and suddenly they've lost huge contracts and they're having to lay off staff, well, then the risk is great and it goes into junk bond status. And you would hope to be getting a considerable risk premium for that. So the issuer is the entity issuing the debt. Bid ask last, same as we have with equity prices and futures prices, etc. It's basically the price to buy that bond, and then what the bid is, what the ask is of people who are actually wanting to sell or buy. It's denoted in units specific to that security. And this is where it's a little bit different, because while there's been a huge move to decimal numbers for a lot of this, there is still a lot of bonds which are traded in fractions. US Treasuries are still traded in 30 seconds. And so you've just got to be aware of that when you're looking at charts. Hopefully whatever software you're using is able to cope with that. I do know some good software that can, but just be aware of that if you're looking at a chart and it's in decimals, that it's not just going to go up by 1 decimal point, it's going to go up by 30 seconds. Convertible is the right to exchange for equity, and then callable is when the issuer has the right to call back that bond, obviously paying off the face value, but you lose that ongoing income stream. Now that can happen with bonds where there is a high rate. So as a company, we put out a bond and we're paying a high rate because that was the best deal we could get at the time. As time goes on and maybe interest rates drop, well, I could refinance and get in another bond at a much lower rate, and then I can pay off the first bond that I paid. So that bond is callable, meaning that the company can pay it off at any time. Bond prices, bonds are priced from the 10-year US Treasury bond. So the 10-year bond in the US is almost like the benchmark. Even a lot of other country bonds are based off that. If they're deemed to be riskier, well, there's going to be a higher rate. If they're deemed to be less risky, then there'll be a lower rate there. And then obviously looking at longer duration, the longer that you're in the market, so 30-year bonds should be paying a premium because your exposure to risk is much, much longer. So they should have a premium over a 3-month bond, going along like that. Then when you talk into corporate, but everything's like this matrix of looking at the US Treasury and working out from there. Corporate bonds have a higher yield because they're not backed by the government. The government can obviously increase taxes, can do quantitative easing and do all sorts of mechanics to make sure that they fulfill their obligations. Companies don't have that same ability. Most TA is done on the futures of bonds as prices and history are more stable. So looking at the US spot is a typical security that we would look at to look at the 30-year bond prices. And so it's a little bit easier to work with. So the yield curve is here. So basically what we're doing here, now this is the 3-dimensional yield curve. The most common one you'll see looks like this, and it's a snapshot in time and just says, right, let's have a look at the 3-month yield all the way out to the 30-year. And you expect to see this. You expect to see a rising yield curve where the longer you hold that bond, the more money that you're going to make from that. But the trouble is that as prices go up, they usually start with the short term. As the Federal Reserve starts increasing short-term rates, well, it starts with a 3-month, they go up straight away, but it takes a while before the longer durations go up. as well. Now, what we're looking at here is actually a three-dimensional version of a yield curve. So we're looking at the front edge here. This front edge matches this line down here. But then we go back 1 day, 2 days, 3 days, etc. And it looks like we're going back about a year. I'm just looking at this window here. This looks like 2004 back to 2003, if I'm reading that right. So we've got about a year of history there. And we can see for that whole year, the curve was right. It was a nice climbing yield curve there. So what we can get as well is an inverted yield curve. Now here's a case right here. This is in, looks like 2007. So probably about March, April 2007, we're sitting at right here. I should look up here, 27th of March 2007. And then the history going back a year. And we can see that right back a year earlier, it was still okay, but then we started getting these points where short-term interest rates were higher than the long-term interest rates at the back. And you can see that here. So we have 30-year here, 3-month there, 10-year in the middle, and we have what we would call an inverted yield curve. Typically when we see that, it's a really, really big sign of a market that's about to roll over and go into a bear market. Happens very, very often. Not always, and we can get bear markets without it happening when there's other economic issues going on, or there's a little bit of government intervention into the bond markets as well. Nevertheless, it's definitely a warning bell if you ever see an inverted yield curve like that. Implies recession and potential market declines, economic slowdowns, etc. Differences in the yield curve are another consideration when focusing on relative value as well. Looking at that, looking at changes in relationships is very important. All right, so that's fixed income and bonds. So obviously the major types of issuers, it's corporates and governments. They're the two groups there. The basic terms, the duration, the maturity, whether it's callable, convertible, all of those terms, make sure you know. I put it out the way that I did so that you can print those slides out and scribble your notes over it. Remember, writing things out by hand is the best way to learn something like this. Explaining the relationship between price and yield, defining the yield curve, describe the importance of the US government debt in pricing other debt. As I said, it's the 10-year bonds, which is really the benchmark that everyone works from. And then looking at the yield or credit spread as well, as we talked about. All right, so that's enough for this one. We'll continue on with the next session. Thank you.